Good afternoon, everyone. I'd like to wish you all a happy new year and thank you for joining us for our quarterly webcast today. My name is Meredith Ward, and as you all know, I'm your Wealth Relations Associate. Today, our presenter is going to be our Chief Investment Officer, Jack Brown. Jack will be discussing our current and long-term outlook on the equity and fixed income markets. Jim Neal is also on the call today, and he will be available at the end when we enter our question and answer portion session. On your screen, you should see a dialog box in which you can type in any question. Feel free to ask them as they come to you, and they'll be answered at the end of the presentation. So to begin, I'd like to welcome to the call, Jack Brown.
Thank you, Meredith, and thank you everyone for joining us. This is an important webcast, in my opinion. 2017 was clearly a very strong market. The first month of 2018 is on pace to be the strongest month since early 2016. And then, of course, today and yesterday were obviously not good days. So trying to put all that into perspective gives us a lot to talk about. When we step back a little bit and look at the market, it's high. It's really on the pricey side. Our bottom line, just to kind of give an advance on this presentation, is that we recognize the high valuation of the market, but we think what's going to win the day, or at least the year, is the idea that the economy looks really good, and that's obviously good for business. So here we are in an environment where prices are high, the economy looks good, but there's some risks that we want to be aware of. So we're going to be outlining those risks and look at the types of things that can cause a correction, or the types of things that might have a bigger impact. So this is kind of a call that addresses all those things. So with that being said, let's jump to the first slide. Okay, so the question is the stock market expensive? Here we're looking at a chart. It's a historical of the price to earnings ratio for the stock market. The far right is where we are. It ends a little bit above 20, and this is based on the price of the S&P 500. We think of that index as the largest 500 companies, a good representation of the market, but it's the price or the index level over the earnings of those same companies. So that's kind of like the average PE for all those 500 companies. What we're looking at in terms of that earnings is the last 12 months. So when we look at the PE based on the last 12 months of earnings, we're right around 20. And if you look at the historics of this chart, you'll see that we're kind of in that upper end of normal. So it's certainly not outrageously high, where it's not cheap, but we appear to be in somewhat of a normal range. So with that being said, there are some considerations to put that into perspective and to kind of help ultimately answer that question, is the stock market expensive? But the first thing I'd like to point to is on the next slide. Here we're looking at profit margins. So this is going to help us solve that riddle, is the stock market expensive? And what this is showing us is that corporate profit margins for the broad economy, so companies across the economy, profit margins are high. Now, this particular chart is looking at corporate profits by the way the Bureau of Economic Analysis collects that data and looks at all the corporate profits in the economy relative to the size of the economy. And that turns out to be a very good way to collect the profit margins for businesses in the U.S. Now, if you look at the historic profit margins in the S&P 500, the charts are very similar. So this is a good representation of what's going on across the board. But what you'll notice is that in the past few years, the profit margins are historically high. And they've been coming down a little bit the past couple of years, but we're still on this very high level. So we all know that profit margins are a good thing, particularly when it comes to companies. And the question becomes, is what are these profit margins going to look like in the future? Well, our view is that eventually they will normalize. And by normalize, we think corporate profit margins will come down a little bit. Now, this has been a concern for a while, but we want to look at the factors that might bring corporate profit margins down a bit to normalize them, if you will. And this particular environment we're in now is an interesting one. So in terms of margins, there's really revenues, money coming in the front door of businesses, and there's expenses. That's the costs of all the inputs in terms of providing goods and services, and the bottom line are corporate profits. So when we look at the revenues, there's a couple things that can impact revenues, and if revenues are squeezed down a little bit, that would make corporate profit margins go down. And on that front, certainly recessions would be a big issue. Now, our view of the economy is that it's looking very good. So we're not concerned at this point with the recession. We think there's a very low probability of that in the next 12 months. But another thing that can bring down sales and revenues a little bit, it would be competition. So as competition heats up in the economy tends to get better and grows faster. You see more competition. But you'll also see more competition with technological changes. So think of Amazon. Amazon is forcing an old sector to really compete aggressively, and so there's a lot of businesses out there that have had to adjust their prices down a little bit, forcing their profit margins down. But that's an example of a competitive environment where corporate profit margins are forced to come in a little bit. That's the top line. Now, if we look at the expense side of the equation, the types of things that could put pressure on profit margins are basically expenses going up. And what are those factors? Well, inflation is certainly the biggest thing to think about. And on that front, you think about our labor market. It's pretty tight right now. And by that, I mean unemployment is pretty low. There's a lot of people getting hired. There's not a lot of people looking for jobs. There's not a lot of people claiming new unemployment situations. So the labor market is pretty tight. What goes along with that is rising wages. So that's an input price, a big one, a very big one going up. The other thing that can cause expenses to go up and ultimately profit margins to come in would be other, traditional inflation, commodities or other types of input prices. And that can happen when the economy heats up as well. So we see some of that. We're starting to see more and more of these type of issues come into play in the past year or so. But ultimately, at the end of the day, we don't think 2018 is really when all these things put enough pressure on profit margins to really hurt them too much this year. So we still think profit margins are going to stay elevated for this year, but maybe over the next 2 to 3 years, we think that profit margins could normalize. Now, what happens when corporate profit margins go down? How does that affect the stock market and things like the price to earnings ratio? Well, when you normalize profit margins, we're basically normalizing earnings. And on the next slide, we look at this, what's called a cyclically adjusted price to earnings ratio. This is a relatively new measure of stock market valuation. Came out by Robert Shiller. He wrote the book Irrational Exuberance, where that name came from. Of course, Greenspan sort of popularized it. But this guy, Shiller, won a Nobel Prize for this collective body of work. So this chart is part of that body of work. At this point in the game, within the past 10 years, it's become widely recognized as a pretty good way to value the market. So when you normalize earnings, which is kind of the same concept as normalizing margins, what we see is that the PE ratio, the same thing we looked at a couple slides ago where it was 20, when you look at it under this lens, it's 33. It's much higher. Interestingly enough, there's only been one time in history where the PE ratio, according to this measure, has been higher, and that's the late 1990s, last 2 years or so of the internet bubble. And so bottom line is we tend to agree that this is a pretty good way of looking at the market. So when we ask that question, is the stock market expensive? Ultimately, we say yes, the stock market is expensive for that kind of few things we pointed out. But ultimately, when it comes to this slide, so the risk to the market, and again, going back to the very first point we made at the beginning of the slide, is we think 2018 is going to be a decent year for stocks. We just, what does the market do in an expensive environment? We think the year is going to be okay, but we certainly want to take a careful look at what's going on and what are the types of things that could bring it down for more than, say, a week or two at a time. We're really concerned about a bear market or something that would cause the market to go down, more than 10% for an extended period of time. So we don't see that at this point in 2018. We feel good about it, but we want to look at the risks, and certainly profit margins is part of that picture. So that last slide gives you our view on that, which basically says we think margins will be under pressure the next 2 to 3 years, but we don't think this year's a big risk for them. We think profits are actually going to go up based on things like the tax change and things like that. So we'll take the profit margin question and earnings risk to earnings out of the major considerations for being a risk this year in 2018. That being said, let's go to the next slide. Okay, so today, if anyone watched CNBC, of course you saw a lot of red on the screen. None of us like that, but basically the market is down, and some of the guys that were on CNBC, we have it on in the kitchen, so whenever we take a break, we kind of see what the strategists and the other folks are saying. But the traders seem to be saying today, people are worried about interest rates going up. So we happen to be looking at this when we put this presentation together back on the 16th. And so what if long-term rates go up? That's the question. Well, there's a lot of sophisticated ways to look at it, but a very simple way to think about it is pure common sense. What happens when rates go up high enough? Will there be a point in time when you say, you know what, I think I'd rather own a treasury bond because I can get X% yield, and that's a pretty low risk because I'll get my money back because the treasury's paying the principal back to me at some point, and I'll collect a pretty high interest rate along the way. So at some point when rates go high enough, it becomes it sort of competes with the stock market, and who wins the jump ball? At some point, the treasuries could do that, and so that puts pressure on the stock market. So there's a lot of sort of big name type strategists who live in the bond world that think we have put the low in interest rates, and we probably did that last year. So here we are. It was as low in the low 1% range. Put this presentation together a week or so ago, and it was at 2.5%. And today, it's come up a little bit, 20 basis points or so. So it's about a little over 2.7%, which is a pretty big move in a couple of weeks. So this has kind of got the attention of a lot of folks. And of course, we do think rates are on the rise. So what causes rates to go up? Usually it's good things. If the economy looks really good, that would be a reason for rates to go up, because generally things are growing. Along with that would come some inflation. So really inflation is part of that idea, is that if prices go up, we have inflation. And so if you own a treasury bond, you need to get a higher interest level to provide you enough income to offset that inflation. So inflation expectations is a reason why rates would go up. So we think that will eventually come into the picture because the economy does look good, and rates are historically low. So we think rates will go up based on that. Now, throw in another idea. The Federal Reserve has built up this large balance sheet over the past several years following 2008. So they had quantitative easing. So instead of quantitative easing, they're probably quantitatively tightening right now. They've come out and said that. And basically what that means is that they're liquidating their balance sheet. And at the end of the day, it kind of means they're selling bonds. They're not actually selling them. They're letting them roll off their balance sheet, which means they're just not going to be buying new ones as things mature and then get reissued. So they're kind of taking themselves out of that market, and that will have some pressure, some upwards pressure on rates. So a strong economy and some pressure from that, it would make sense that rates will go up from here. We just don't see it as a major problem in 2018, because when we run the analysis historically, what it shows us is that it's really not a major problem, interest rates, until they go up to a level that's close, that competes with the stock market, is ultimately how my partner Jim Neal phrases it. But essentially, when rates go up to compete with the stock market, it means they'll probably go up in that 4.5% range, and then certainly they'd be offer a competitive threat in terms of stock market valuation. So that's another way of thinking about it. We just don't see that happening this year. So in any case, that's our view on interest rates. Sticking with the bond theme, let's go to the next slide. So perhaps an even more important relationship in understanding the stock market is the idea that stocks are basically, equity positions or ownership positions in businesses, and these businesses also issue corporate bonds. And interestingly enough, corporate bonds and stocks, there's a pretty close correlation. There's certainly a correlation between corporate bonds and stocks. And so this particular chart shows us the yield difference between corporate bonds and treasury bonds. So when people feel really good about corporate bonds, you'll see that this blue line goes low. So people are willing to accept less of a yield relative to treasuries if they like corporate bonds. So right now we're in this environment where people feel very good about corporate bonds. We're not getting that much of a spread and over treasuries, and so the confidence level in corporate bonds is really high. Now, interestingly enough, if you look at this chart and you plot it against the stock market, whenever you see one of these peaks, like we did in early 2016, or we did in 2008, or we did in the early 2000s, the market tends to go down. So there's a real negative correlation between this particular chart and the stock market. And here we are with very low spreads, which means at some point they'll go up. That spread will go up, and we'll probably see the stock market go down with it. So the question becomes, is when is that going to happen? We don't see, in the current economic environment, we don't see this as a big risk because there's a tremendous amount of confidence in the economy and in corporations. In early 2016, we saw this chart peak up. It had a lot to do with the energy market. And there was a lot of trouble in the energy market, and we saw some bankruptcies and that sort of thing. And the overall bond market took a hit, but the stock market, as you'll recall, in early 2016 took a pretty good hit too. And so that correlation certainly stood then. So here we are. We're in a decent groove, if you will, with the economy. We think the tax reform is certainly going to add some additional boost to the economy. So certainly for 2018, we feel pretty good about what we see. And so this chart really doesn't scare us at all. We think it's a positive sign for the stock market. Next slide, please. So the last chart that it's a sort of a technical presentation, and I appreciate you bearing with me, but these are all really pertinent slides relative to what's happening with the market and the current thinking. But this is a yield curve, and simply put, it's a 10-year Treasury bond minus a 2-year Treasury bond, and this is a very interesting relationship, simply because when you subtract the one yield from the other, you get this chart, and you plot it out over history, and every time this chart, this line goes below zero, they call that a negative yield curve. It's really, if you plot out the different yields, the slope of that curve looks negative, but it actually goes below zero. So that's probably the easy way to think of it. And every time the chart goes negative, we tend to have an economic recession. So what's going on here? Well, when short-term rates are higher than long-term rates, this yield curve is negative. And so when that happens, if you think about it, it's a little more expensive to borrow money short-term than long-term. That's unusual. Most corporations, whether they're financial or non-financial, sort of rely on the lower yielding short-term rates, whether through their financing rates would need to be lower than their long-term investment returns. And the normal relationship there would sort of imply that you need to have positively sloped yield curve. When that goes negative, it kind of slows things down and provides a lot less incentive for businesses to do things. And that typically leads to economic recession. Now, the Federal Reserve turns out has a pretty interesting role here, because every time they raise rates, they're raising short-term rates, and they're making that yield curve be less positive and potentially negative. So the Federal Reserve will have a role in the shape of this yield curve. And at the end of the day, they seem to be pretty cognizant this go around that negative yield curve would lead to a recession. So I think they're going to be painfully aware of problematically causing a negative yield curve, and they'll likely avoid it as a result. But so here we are. The yield curve is certainly what seems to be talked about. Is it's been going down the past several years, so it looks like it's charging quickly towards zero. Do we think that's going to happen? The confidence that it's going to happen is very low. In other words, I don't see it going to zero, mainly for a couple reasons. One, I think long-term rates are going up. And two, I think the Federal Reserve is painfully aware of the consequences of a negative yield curve. So when you put those two things together, the math really isn't there for it to go negative. Now, I don't think I'm in the majority camp there, but I just don't see it going negative at this level. It's trending that way, but it's probably not going to go there. In any case, that's bottom line there is that we feel pretty good about the economy. We certainly acknowledge that the market is at a overvalued state. We look at the major types of things that could derail that market, whether it's margins or interest rates or yield curves or corporate bonds and profit margins, but etc. We think the stock market's going to be perfectly fine this year. Clearly, a correction can happen anytime. It certainly looks like, the past couple of days gives a little pause for a lot of folks, but at the end of the day, there's the reasons for it to be a major correction aren't there. So this, in our view, could likely be a short-term sell-off and then would recover fairly quickly. That's the bottom line of where we are. And with that being said, it makes sense to keep kind of a strategic outlook on how we allocate investments. And part of that thinking is not only from a pure investment standpoint, but also makes sense to look at sort of a broader, more comprehensive approach to how we help you manage your finances and your wealth. And on that front, I wanted to just let you know a little update that we've done as a firm. We decided to broaden our offering in a sense. We have been purely an investment firm. Investing is in our DNA, and we love to invest and implement different investment philosophies to provide excellent returns. But we think that offering a broader array of services made a lot of sense. So on the next slide, I want to introduce to you a couple new gentlemen that have joined us. We are thrilled and honored to have two fellows, Jack Campbell and Matthew Johnson, join us. These are very seasoned investment professionals who have built long careers in the financial planning and wealth advisory roles. And we think the future direction of this firm relies on these two gentlemen to help us offer not only excellent investment solutions, but also a broader array of wealth advice. Jack Campbell, I've known for over a dozen years. He's a great guy. He's originally from Boston. He had about a 15-year career with Fidelity Investments. He joined one other firm since then, and now we welcome him here. So thank you, Jack, for joining us. The second gentleman, Matt Johnson, he graduated from Syracuse and has basically had one employer since, and he has been at his firm, City Wealth, for 15 years. He has built a good practice up in Manhattan. He moved down here with his family just recently. And so we are very pleased to have him join us too, and we thank him for joining us as well. That's really the background there, and just wanted to make sure that everyone was aware of what's going on here. With that, I'll turn it back to Meredith to see if we have any questions.
Okay, great. Thank you, Jack. We will now open the call for our question and answer session. So we'd like to keep the questions to just general questions on the bond and equity market. And if you have any specific stock questions, please contact us privately and we'll be happy to speak with you about them. So our first question is, given our outlook, do any sectors look particularly risky?
Yeah, that's an interesting question. You know, on the one hand, you look at a variety of sectors, and because we think the market's a bit overvalued, we could certainly make the case that there's a lot of individual sectors that are overvalued. So from a valuation standpoint, there's certainly a bit of that spread across the board. But given our view overall on the economy, I think one area that there may be some risk to a bit more than usual, you'd see that a little bit in what's going on, is the utility sector, specifically because if rates go up, they're really, you know, they do a lot of their financing based on long-term bonds and preferred stocks and things like that. So they're financing, you know, they're heavily levered type businesses. And so I think their profit margins would be squeezed a little bit if we continue to see rising interest rates.
Okay. Next question is, where do you see opportunities?
Right. So, yeah, that's a good question. You know, along the same lines and sticking with some of the themes that we've identified, the financial sector, there's always seems to be a lot of very interesting opportunities in there. Banking, traditional banking, for example, they rely on a positively sloped yield curve, and so rising interest rates actually help them. And so if we're right about our outlook, strong economy and reasonable short-term rates, that would certainly help them. So, and that combined with a strengthening economy simply means that banks are probably going to be doing a lot of business. The other thing that tends to happen was when the economy heats up, that whole capital markets area, whether it's traditional banking or investment banking, and those type of areas tend to do very well also. So the traditional business revenues that they would generate would do well, in addition to type of things we see going on in interest rates. So that's an area where I think there's probably continued opportunity. It's done well. I think it will probably continue to do well.
Okay. There's another question here. There's considerable discussion about an infrastructure bill coming out of the current administration. Do you see that as a possibility? And will there be market opportunities in the infrastructure companies? Any favorites?
Our star political analyst is James Neal, and if he's on the call, I'll ask him to take this question.
Yeah, I'm happy to. I suggest all of you watch the State of the Union address tonight. I think the president's going to spend quite a bit of time talking about the economy and in particular what he wants to do going forward. I heard today that Gary Cohn, who's his chairman of his chief economic advisor in the White House, who also was, prior to coming to Washington, the chief operating officer of Goldman Sachs. Mr. Cohen wrote the speech tonight, and I think you're going to hear a great deal about infrastructure. It is one area where you might, and I use the word might, expect some bipartisan cooperation in going forward. There may be enough opposition to Mr. Trump that some people, the never Trumpers, will say no, they won't support it. But in the fall is an election, and I think it will be difficult for people standing for re-election to move against a bill that has some bipartisan broad support. So yes, I think there will be a lot of discussion about it, and I think there will be opportunities. But I think we need to listen to what he has to say tonight, and then over the next couple of days, we'll have a pretty good feel for where they want to go and what the prospects are for such a bill going forward.
Thank you, Jim. I have one final question here. How do you see value and growth playing out for the rest of the year?
Yeah, that's an important question. We do manage a growth strategy in addition to a value strategy. So we have a vested interest, as our clients do, in understanding those two different styles. And over the long run, they both do very well. It's just that some of them will do better in certain climates than others. 2017 was certainly a great year. If you owned a good swath of the technology area or pharmaceuticals or healthcare in general, you did great. Value did not do quite as well. I think it had a decent year, but certainly not nearly as well as the growth side. What tends to happen is that when the economy heats up, you'll see the names that were maybe less loved in the value space or even the small cap space in this current environment. Those type of names tend to do really well as the economy starts to pick up steam. And so my guess is that if we see some surprise upticks in GDP and that sort of thing, we'll start to see the value side of that spectrum do pretty good this year.
Thank you, Jack. Well, thank you all for joining us today. I think that concludes our broadcast. If you wish to revisit it, I will be emailing the replay link to everyone, and it will also be available on our website within 24 hours. As always, we welcome your calls and are here to help should you need anything, and we are appreciative of your continued confidence. Have a great day, everyone.